everybody, and today we will talk about IPO, initial public offering, the first time that the stock of the private company is sold to the public. Got a little crazy in days of dot-com mania of the 1990s. Back then, investors could throw money into just about any IPO and be almost guaranteed killer return at first. People who had a foreign to get in and out of these companies made investing look easy. Unfortunately, many newly public companies like Linux and the Globe.com experienced huge first-day gains, but ended up disappointing investors into the long run. Soon enough, the tech bubble burst and the IPO market returned to normal. In other words, investors could no longer expect the bubble and triple-digit gains they got in early tech IPO days simply by flipping stocks. Nowadays, there is once again money to be made in IPOs, but the focus had shifted. Rather than trying to capitalize on the stock's initial bounce, investors are more inclined to carefully scrutinize its long-term prospects. Getting in on IPO. First thing first, to get in on an IPO, you will need to find a company that is about to go public. This is done by searching S1 forms filled with the Securities and Exchange Commission. To participate in IPO, an investor might register with the brokerage firm. When companies issue IPOs, they notify brokerage firms, which in turn notify investors. Check our website in order to find your IPO you're interested in. Pressing for investors, invest in IPO, so you can find all the information about upcoming IPO, as you can see from the website. I will leave a link under the video. Most brokerage firms require that investors meet some qualifications before they participate in IPO. Some might specifically that only investors with a certain amount of money in their brokerage accounts or certain number of transactions may participate in IPO. If you are eligible with the firm, with usually have you signed up for IPO notification services to receive alerts when new offerings meet your investment profile. If you decide to take a chance on IPO, here are a couple of points to keep in mind. Big, deep, or objective research. Getting information on companies set to go public is a thought. Unlike most publicity-traded companies, private companies don't usually have swarms of analysts covering them, attempting to uncover possible cracks in their corporate armor. Remember that although most companies try to fully disclose all information in their prospectus, it is still written by them and not by all unbiased third party. Search online for information on the company and its competitors' financing, past press release, as well as overall industry health. Even throughout good intel may be scarce, learning as much as you can about the company as a crucial step in making a wise investment. On the other hand, your search may lead to discovery what companies' prospects are being overblown and what not acting on the investment opportunity is the best idea. Try to select company that has strong underwriter. They are not saying that the big investment bank never bring above public, but in general, quality brokerages bring quality companies public. Experience more caution when selecting smaller brokerage because they may be willing to underwrite any company. For example, based on its reputation, Goldman Sachs can afford to be a lot pickier about the companies it underwrites than Jones Investment House can. However, one positive and boutique brokers is that because of their smaller client base, they make it easier for the individual investor to purchase pre-IPO shares. Be aware that most large brokerage firms won't allow your first investment to be an IPO. The only individual investors who get in IPOs are long-standing, established, and often high net worth customers. Always read the prospectus. We have mentioned not to put all your faith in the prospectus, but you should never skip purchasing it. It may be a dry head, but the prospectus lays out the company's risk and opportunities along with the proposed users for the money raised by the IPO. For example, if the money is going to early loans or to buy the equity from founders or private investors, look out. It is a bad sign if the company cannot afford to repay its loans without issuing stocks. Money that is going toward research, marketing, or expanding into new market paints a better picture. Most companies have learned that over-promising and under-delivering are mistakes often made by those one for a marketplace success. Therefore, one of the biggest things to be on the lookout for right to reading a prospectus is an overly optimistic future earnings outlook. This means reading the projected accounting figures carefully. You can always request the prospectus from the broker bringing the company public. Be cautious. Skepticism is a positive attitude attribute to cultivate in the IPO market. As we mentioned earlier, there is always a lot of uncertainties surrounding IPOs, mainly because of a lack of available information. Therefore, you should always approach an IPO with a caution. If your broker recommends an IPO, you should exercise increased caution. This is clear indication that most institutions or money managers have gracefully passed on the underwriter's attempt to sell the stock to them. In this situation, individual investors are likely getting a bottom feed, the leftovers that the big money didn't want. If your broker is strongly pitching a certain offering, there is probably a reason behind the high number of these available shares. This brings up an important point. Even if you find a company going public that you deem to be worthwhile investment, it's possible you won't be able to get these shares. Consider waiting for the lockup period to end. The lockup period is legally binding contract uh, between the underwriters and insiders of the company, prohibiting them from selling any shares of stock for a specified period. The point here is that you're waiting until insiders are free to sell their shares is not the best strategy because if they continue to hold stock once the lockup period has expired, it may be an indication that the company has a bright and sustainable future. During the lockup period, there is no way to tell whether insiders would in fact be to take the spot price of the stock. Let the market take its course before you take a plunge. A good company is still going to be a good company and a worthy investment even after the lockup period expires. Remember that the single most important goal of the IPOs for many companies is to raise cash. The higher the price it can sell its stock, assuming the same number of shares are sold, the more cash the company receives. Once the company goes public, it can regularly issue more shares without putting downward pressure on its valuation. As a result, correctly pricing the IPO is vitally important to the company in its early stages. The nice thing about looking back on the Facebook IPO is that it provides a longer-term perspective. Facebook's IPO was the most anticipated public offering in the technology sector since Google went public in 2004. Demand for Facebook stocks was so high that the company increased both the range of its share price from the 29 to 35 to 34, 38. The number of shares it planned to sell by 25% just days before the IPO. This last minute decision increased the company cash receipts and the astounding $5 billion. so 51% versus the original plan. The IPO price was 13.8 and the stock opened at 42.05. It then trended down, finishing at 38.23, nearly identical to the IPO price. In contrast to Uber, the IPO wasn't summarily declared a failure. Over the next weeks and months, Facebook's valuation comparison continued. With the stocks, so search for the company you're interested in more as carefully as you can. Pay attention about all information. Wish you great investment. Stay safe and see you soon.